There's a saying that history repeats itself. This statement might be debatable, but if we look into the past, there is definitely one unavoidable thing: the crisis.
As the recession deepened through 1982, its effects were felt across America.
This could be the most serious recession in decades.
How is the pandemic, how did it and how is it still affecting our economy?
Oh boy, in so many ways.
No matter how hard we try, economic turmoils happened and will always do. That's why you should always prepare yourself and invest wisely to protect your hard-earned money. Real estate and gold can help with that, but which one is better? And is now the right time to invest? Let's find out. Even if you're not too close to the idea of investing, we all have that notion that gold and real estate are relatively stable, profitable, and time-proven. Many of us understand that getting such investments might be a good idea, but most people are still holding back. And often, this waiting period can make you lose money. How so? Well, let's imagine a situation. You have earnings, save something up, and you just are waiting for the right moment to invest. But have you ever thought of why big companies or investors rarely sit on their cash? Why do they invest all of their money or most of their borrowed funds in commodities, real estate, bonds, and the stock market? They do it because these investments appreciate over time and generate income for them. Look, you don't need to be an economist to understand how this works. This is how the price of gold has increased over the years. These are the prices of housing in the US. And this is the US dollar's worth over the last century. Yes, you see this right? The value of gold and real estate actually grows over time, whereas the dollars get cheaper. How's that possible? So there's an indicator called M2. Under this not so obvious name, the Fed keeps track of the currency flowing around the US economy. This broad measure includes cash, checking, and saving deposits, and money market securities. Economists and investors use the M2 indicator to check the changes in their total money supply. This way, they can predict future inflation. So this is how the amount of currency increased in the 60s. Here, we're talking 300 billion in 10 years. The following 10 years will bring a growth of money supply of almost $8 trillion. In the next 20 years, the amount of currency in the US outside of the Fed and the Treasury will see an increase of over $3 trillion. But the 21st century definitely beats every period before that. In the past 23 years, the amount of currency in the American economy grew from less than 5 trillion to over 21 trillion at its peak. And it doesn't only happen in the US. Here is the money supply increase in Japan, China, the UK, Canada. And it will be similar for pretty much any country. So where do we actually take all of this money from? Well, it's printed to grow the economy, cover all social payments, and continue all the public activities the government is responsible for. And as we've seen, the governments are printing money in every single country. Now, the question is, for how long can they actually do that? This whole money printing situation can't last forever, right? If you've been following our content for quite some time, you know we always try to get to the bottom of everything. And this is what we found. It has to do with fiat currencies and their longevity. Fiat money is a currency that is not backed by any commodity, like gold or silver. Nowadays, pretty much all of the currencies we know are fiat currencies. Over the course of human history, we had around 800 fiat currencies, at least that we know of. And by now, only 200 of them are still in circulation. We also have to remember that for the most part of human history, all currencies were commodity-based. So the whole idea of money that isn't backed by anything tangible and valuable is relatively new. The first evidence of the fiat currency system was discovered in China in the 11th century, but we started to adopt it more or less actively around the 18th century. And even though it isn't such a long time frame, over 75% of all the ever existed fiat currencies are vanished by now. What are the main reasons for their failure? Well, historians say that 20% disappear through hyperinflation. 21% were destroyed by war, 12% dissolved because of independence, 24% were monetarily reformed, and the other 23% are still in circulation. And could you imagine that the average life expectancy for a fiat currency is only 27 years? Well, it doesn't always work like that. For example, the British pound sterling was founded in 1694 and is the oldest fiat currency in existence. Yet, many economists say that you can barely call it a success. Why? Only in the last 50 years, the buying power of a pound fell by 93.88%. What was 1 pound in 1971 got to be 6 pennies in 2022. So, history shows that every currency collapses sooner or later. But could the US dollar last forever?
Short answer, no. Long answer, no.
Should you now go and get rid of your dollars? Of course not. This is what the experts have to say based on history. But the truth is that we don't really know what can happen and when. The US dollar might last for hundreds of years, but what we should really focus on is its value. How much will your money be worth in a year from now, in 5, 10, or 50? Today, we say that the money supply is getting higher and higher globally. That's why the more dollars we print, the lower its purchasing value will be. And through our content, we seek to teach you how to protect your earnings. And that's where gold and real estate come into play. They are some of the most stable and time-proven investments. But why is that? First, let's talk about gold. We often forget that the monetary system we have now was once based on gold. Before all of these banknotes and credit cards, all we had was the gold that could pay for goods and services. But you know what's fascinating? If you get into the history of all the Asian countries and empires like Mesopotamia, ancient Egypt, ancient Greece, or even the Roman Empire, they all used gold and silver to buy things. These empires existed thousands of years ago. And now, here we are in the 21st century, and the price of gold reaches its all-time high. But how can something like this happen? In the end, we're living in the digital age with all of our devices, AI, virtual reality, and people trying to colonize Mars. Yet, still, the metal that has existed for ages has appreciated more than ever before. The main reason for that is the scarcity of gold. You see, gold is limited. And unlike fiat currency, no government can print more gold. The same happens with real estate. People want to live in certain areas, cities, or states more than others. And land is also limited. That's why houses appreciate over time. Of course, home ownership is rather a new concept, especially compared to gold. But through many crises, we see the same tendency. Real estate prices are not too volatile. While stock prices can drop in a day, the value of real estate isn't that reactive to economic turmoils. So both gold and real estate seem to be good investments. But which one is better? Let's see the most important differences and similarities. The first crucial aspect is affordability. Of course, I could tell you, go and get a house, but it is not something that is done without preparation, much less from one day to the next. Buying a house requires a down payment in most cases and at least some financial stability to ensure you can make your monthly payments. So in this case, gold has a significant advantage because you can start investing with pretty much any amount of money. Besides, it doesn't require any monthly payments because most likely you won't get a loan for this. On the other hand, real estate can be also more affordable than you think. If you are eligible for down payment support programs and you work on the items that can lower your monthly payment, you can save on buying a house. I talked about more about these opportunities in this episode, so feel free to check it out after watching this video. Now, back to gold versus real estate. We've seen the affordability aspect, but what's going on with the potential returns? On average, during the last 20 years, gold had a return of around 11%, but it might differ from year to year. In the same graph, we see that these are similar to the returns that real estate investment trust REITs provide annually. REITs are the companies that own or finance income-producing real estate and pay dividends to their investors. For those looking to learn more about REITs and invest in them, here is an episode for you to watch after you're done with this one. Now, If we take a look at investing in the property itself, the returns will be slightly lower. You see, residential properties have an average annual return of 10.6% and commercial properties of 9.5%. But of course, you can only expect these numbers if you hold your property for at least 10 years. In fact, both gold and real estate appreciate over time, but often when the economy is thriving, real estate tends to increase in value because a strong economy often means low unemployment rates, low inflation, and low interest rate. And as for gold, people often return to it as a safe haven in times of turmoil and crisis. So the price of gold tends to rise when the economic situation is unstable. So if you're thinking of investing in gold, the more viable strategy will be to buy it when the demand is lower. The next thing that is different for gold and real estate as an investment is income generation. If you buy properties, you can rent them out and get a monthly income. Similarly, if you invest in the stock market, you get dividends. Yet gold is different. When you buy gold, it holds its value and appreciates over time. So if you sell it after holding it for some time, you will get earnings, but you can't expect any monthly income from investing in gold or any other precious metal. But on the other hand, gold performs better in terms of liquidity. Imagine you want to sell your investments to get your money back. Selling gold will never be an issue because it is an easy process and doesn't require much interaction from you. When you sell real estate, there is more to the equation than just selling the property. You need to work on finding a realtor, negotiating, maybe even making some repairs. You need to also wait until you find the right buyer, and so on. The next factor that is different for real estate and gold is their maintenance. Any property requires ongoing expenses such as property taxes, insurance, and repairs. And these costs can impact the overall return on investment, the ROI. Gold may also require storage and security expenses if held in physical form. But these costs aren't that high compared to all the potential ongoing spending on properties. Demand and supply are other crucial factors when comparing gold and real estate. For example, now we're facing times of inflation, and as a result, the Fed raises interest rates to stabilize the economy. That's why fewer and fewer people want to invest in real estate and pay higher interest rates on their mortgage. So the demand for housing is decreasing. At the same time, gold is often seen as a hedge against inflation. When the purchasing power of currencies goes down due to raising prices, the value of gold tends to rise. That's exactly why investors often turn to gold to protect their wealth and preserve their purchasing power during periods of inflation. And of course, we can't ignore volatility. Gold is reactive to the market. So, for example, these are the changes in gold prices over the course of 1 week. The highest point we see here is $1,971 per ounce, while the lowest price for that particular week was $1,926 per ounce. So the difference between the maximum and the minimum prices was $55. If we compare gold to the stock market or cryptocurrencies, it won't seem that volatile. Yet, when we compare gold to the housing market, the situation is completely the opposite. For example, if a house costs $300,000 on Monday, it will most likely cost the same $300,000 on Friday. So let's sum up. Gold has a lower entry barrier because you can start investing with less money compared to real estate. Real estate, on the other hand, can generate monthly income. Both of the assets have similar yearly returns, but to fully experience those returns, you will need to wait some time. For real estate, this time frame will probably be longer. Gold is more liquid and you can sell it faster and easier than real estate. Real estate has higher maintenance costs, which might influence the overall ROI. Demand and supply for gold and real estate will depend on the economic situation. When the economy is strong, real estate tends to go up in price, while gold appreciates during times of crisis. And finally, gold is more volatile than real estate as it is very reactive to market changes. Now that you understand the pros and cons of both gold, and real estate, we have to mention the diversification factor. Every financial advisor will tell you that this is the most important rule of investing. You can't know for sure what will happen with the markets. When you put your money into different baskets, you protect your funds and ensure that you will always have a balanced capital. If the prices of some assets go down, other things in your portfolio might grow. So investing only in gold or only in real estate isn't the best idea. You can diversify your portfolio by leaving one part in cash and getting some bonds, stocks, securities, real estate, gold, silver, etc. There's no right strategy. It will greatly depend on your budget, goals, and overall preferences. Generally, financial experts recommend dedicating between 5 and 20% to each asset type in your portfolio. Besides, you can leverage some assets to help you increase your wealth to get into other more costly investments. For example, you can invest in gold as a starting point. And if you hold it for some time, it will accumulate value to give you further investments opportunities. It can be a great addition to your savings and mortgage financing to buy a house later on. Alternatively, when you get the real estate to rent it out, you can invest a certain percentage of your rental income in gold, silver, or other assets. Those are just two examples of how gold and real estate can work together. So there is no really a right or wrong approach to this. It's just a matter of understanding what you are looking for, understanding what your current financial situation is, and what you can do to achieve your financial goals. And most importantly, don't be afraid of investing, because that's what can create wealth over time for you and your family. Start with something small, be consistent, and educate yourself to know what is best for you. And if you want to learn more about how to start investing smartly, check the video on the screen now. And I will see you in the next video. Bye-bye.